So there's been a pretty big shift in the interest rate outlook over the last quarter as a result of the war in Iran, which of course has caused a major shock in energy markets around the world. It's caused a significant spike in the price of oil, and so as a result, the inflation outlook has shifted quite a bit versus a quarter ago before the war began. So whereas central banks were maybe expected to be able to lower interest rates over the course of this year, they're now expected to, at the very least, no longer lower interest rates as the year progresses, and maybe even begin hiking interest rates toward the end of this year. Markets, a quarter ago, were pricing in a couple rate cuts in the US in 2026. That's shifted now to the point where the market is pricing in a full rate hike by the end of the year. And so a pretty big shift in that interest rate outlook in just several months. In our view, the US is unlikely to change its interest rate over the next year. At least that's our base case forecast. And really the result of that is our assumption is that any sort of inflation pressures from the war in Iran are likely to be temporary. Ultimately, we think a deal gets made, the conflict is resolved, oil prices can come down, but likely not to levels that were seen before the war. Oil is probably going to settle at a level that was slightly higher than before the war began. Ultimately, though, as we get into 2027, we expect inflation pressures to level off and moderate, and ultimately it depends how central banks decide to respond to that and whether or not they agree with those inflation pressures being temporary. If that's the case, we don't see the need for any sort of aggressive hiking by central banks, at least in the US. In Canada, we look for 50 basis points in rate hikes over the year ahead, but in the US, we look for no change.